Thank you very much. First of all, thank you for the Age Community and Services for inviting me here today. Loss and risk management, in a very short few words, we do manage registered and self-insured workers' compensation schemes for small or medium-sized and large companies, and we do run safety management systems. We write them, we audit them, we improve them, and we deal with them in all aspects. Coming here today, a lot of people are very interested in legislative requirements and audits. I understand you want to hear about the cost benefit of self-insurance versus remaining in the experience rated systems. You want an indication of the resources required for the ongoing management of self-insurance, and perhaps to identify some sticking points and who can assist you. We like to think it's us. The Act refers to self-insurers as self-insured employer, and private self-insurers such as yours are covered by Section 60 of the Act. On becoming self-insured, you will be required to manage and fund all your workers' compensation claims. Where you have an outgoing liability, these claims will be passed on to you as soon as you become self-insured. So all the sins of the past are yours. The WorkCover will pay you a return premium, providing there's enough money in the calculation. The calculation is the last 7 years of what you paid in premiums to WorkCover, less the paid to dates. They then multiply that sum by 80%, and that's the maximum sum available to you as return premium. We had an employer come to us in December last year, and the actuary assessed its outstanding liability at $1.6 million. We're fortunate in that process to have a recovery of $250,000, and right now, as at the 31st of last month, the liability is $460,000. Now, if that goes to its natural progression, and had the employer got a return premium, that's his to keep. The money you get in return premium is fixed. You settle the claims for less, you keep the money. If you settle the claims for more, it's going to cost you. Self-insurance status is granted by the board of WorkCover Corporation. They will initially give you a license for 2 years, and they will come back in 2 years and assess your total program, injury management, and your OHS program. After the first 12 months, they'll come back and assess your injury management program, because all you have at the start is a program. You'll have no history. Self-insurance is subject to a lot of terms and conditions set out in the Code of Practice for self-insured employers, and your license can be reduced or not renewed by WorkCover if the conditions are not met. Now, I don't know any company who's had their license taken away from them, but nonetheless, the provision is there to do so. You'd have to pay a premium to WorkCover when you're self-insured, and the premium you'll pay for the first 10 years is 5.2% of what you had paid to WorkCover had you been registered. That money goes to WorkCover, and it goes to pay for the medical panel, the Workers' Compensation Tribunal exposure, and of course your evaluators from WorkCover, who you'll get to know very, very well. Included in that amount of money you pay to WorkCover, they also put 1% of that money into a fund. Now, you already have a financial guarantee that you have to make out in favour of WorkCover, and they collect an additional amount of money just in case the odd employer can't meet his liabilities, the cash in the bank guarantee is not enough, and then they have a self-insured contribution aggregate that's there to back them up. Now, that aggregate is probably about $34 million at the present time, and a prime example of that is when Nalix went into receivership. They couldn't pay the liabilities. WorkCover cashed in the bank guarantee immediately, and if these claims were to exceed the amount of the bank guarantee, well, then that fund is there to pick up the outstanding liability that's not covered. To start off the application process, you'll have an expression of interest, and that's walking down to WorkCover and having a meeting with Lindsay Beard. You want to be self-insured. and state your reasons why you want to be self-insured. The first reason is you want to save money. And if that's not your first reason, he knows you're lying, because it is. The second reason might be that you want to service your employees better. You want to have a better outcome from workers' compensation claims, and you can go on from there. In due course, there is an application fee to be paid, and that pays the cost of the evaluator evaluating your business. You'll have to provide a WorkCover with a copy of your annual report that includes your financials, and you will be starting at that point. If not, you'll have developed your safety and your injury management systems. In due course, WorkCover will come out and have a look at it and give you some advice on how to get there. You're required to consult your unions, and some unions will say, we don't believe in self-insured, but we got no particular reason against your company, because self-insurers manage their workers' compensation claims better. Once that's done, it's a decision of the board for you to be self-insured. Just before you're self-insured, you're required to have an actuary study, and the actuary, their report is paid by you, selected by WorkCover, and that is the basis on what your return premium will be. I have to say that a lot of people don't understand actuary reports, and the first thing they do is they send it off to WorkCover because they have to, and then they put it in the bottom file, and there it stays. There's a lot of valuable information in an actuary's report. It tells you how much money it's going to cost you for the next year, and it gives you the trends. Your your director of finance will really appreciate the information that's in there. The remaining costs of WorkCover to get up there depend on you. You have to get your OHS program up to speed to their standard, and you have to get your injury management program up to speed. When we do our costings and we sit down with our clients to do that, we can see we got two examples where the cost benefit to them is $2 million a year. That's the difference between them running a fully costed workers' compensation program as being against insured with WorkCover. And the quicker they're there, the quicker they start getting that money in. And sometimes we sit there and say, why don't they just spend the money and get up there and do it? But that's their decision on their time frame. WorkCover will tell you there's no time frames to be self-insured once you make your declaration. There isn't in the Act, but WorkCover a policy that says they're likely to be there within 2 years. The record is 10 months. Normally it takes companies about 1.5 years to get their license. The time is yours. The quicker you get there, the quicker you start saving money. And once the board grants it, in the early days I've had licenses granted, and I've had a phone call and it said, you're self-insured as at yesterday. Well, I think they might give you 10 days or a little bit more time, but by that time you're well and truly over it and you're ready to go. Now, there is a criteria to be self-insured, and the first thing you have to be a body corporate, and all the companies underneath that body corporate have to be linked. You would want to own all the linked companies by 50% at least, or 50% and have management control. The financial criteria is quite straightforward. You should have a net worth of $50 million. You should have a gearing of 2 to 1 or less, liquidity of 1.3 to 1, and a profitability of 10%. Now, not every company has that, and there'll be any number of companies who do have that. In the not-for-profit sector, WorkCover will take into account the bonds. They consider that to be an asset, and that will help you with calculations. And perhaps you can even go to the bed licenses, because that's something you can sell, and that's of value. WorkCover will check on your Dun & Bradstreet report, and that simply says that you pay your liabilities of your business better on average for your industry. You have to comply with the code of practice. That's work health and safety and injury management. You have to have a robust system. Your procedures have to to be detailed, and you have to do what your procedures tell you to do. Your procedures, they're aligned to your business. The more time you take in getting your procedures right, the easier it is. You will set KPIs, and you will have audit questions next to your procedures. So once your procedures are directed to a particular manager in your company, he will know exactly what to do. He will know exactly what audits to do, and they're not troublesome audits. They all come back to your procedures. His KPIs can be linked back to performance appraisals. He will know exactly what to do, and his predecessors will. Based on the actuary report, you're required to provide a financial guarantee. A financial guarantee takes various forms. Traditionally, it was always a bank guarantee, and the banks charge you interest rate that you can negotiate with them. The best ones I've seen is 0.5%, 0.77. The average is about 1.5%, and some of them are as high as 4.25. You can now buy an insurance bond. An insurance bond is perhaps a little bit cheaper than a bank guarantee. Well, you wouldn't buy it unless it was cheaper, unless you didn't want to have a bank guarantee and you wanted an insurance bond, and that would take it off your financials. You could go along and buy a Commonwealth bond, make it out in the name of WorkCover, and you retain the interest. You're required to have an excess of loss policy. And in the scheme of things, I think that's quite cheap. Excess of loss policy means that if you were to have one incident and 10 paraplegics come out of that one incident, it would cost you $500,000 indexed, and that would be the total cost of that claim. And it doesn't matter if 10 people were in there and 10 people had $1 million claims, you were governed by that one deductible of $500,000 index. Some clients take out fines and penalties that are associated with their excess or loss policy. And that simply means if you get fined or you have a penalty, that is covered by your excess or loss policy. One that we do and provide our clients is provisions of claims data. You have to have a claims data system that has to record all the information. It produces you monthly reports or reports on demand. It leads into all the graphs I'm about to show you. It does your EDI transmissions to WorkCover that have to be squeaky clean. It's an expensive bit of software because we have so many clients and we can share the cost. We can do that fixed, and it comes down quite nicely. So instead of a $100,000 account, we can reduce that and have fixed pricing as we go through. For claims administration, you have to have an effective policy, procedures and systems. You have to be able to resource it. And for smaller companies who don't have that many claims, it's very hard to get an absolutely top-notch claims manager because he wants to manage claims. And if you only have 20 claims a year, you're going to give him other work, and that's the last thing he wants. So that's where we come in. We do hire top-notch claims managers, and we do spread them over a number of clients. So they're doing exactly what they want to do, and they can produce a service. And I'll show you an example very soon of where we are. WorkCover want to know that you're fair and equitable in claims management. And when you do that, your claims start to plummet, your workforce understands where you're coming from, they're treated properly, and your claims cost will be reduced.